I want to get into what Terra and Luna are and were, and why they were fundamentally broken.
Yeah, it might be helpful to just walk through the day I wrote the thread.
Yeah.
And so that was Monday. Boy, now I'm forgetting the actual date, but that was Monday.
2 weeks ago, right?
2 weeks ago. And I have a day job, and I was watching the DPEG happen in real time, and I was like, wow, nobody is covering why this happened. And I had done a bunch of research on Luna around the Abracadabra crash that we can get into back in February. And I covered Iron Titan and Faye and some other stablecoin failures or stablecoin issues. So I was kind of well positioned to cover it. And, you know, I started digging in and I realized this was an algo failure like any other. So it's worth talking about what Terra is. Terra purported to be a network to support an ecosystem of stable currencies. They had actually had a bunch of real world use and adoption. There was this Korean payments application called Chai that's like Venmo for Korea. They had adopted UST. And the point of the network was to facilitate transactions in stablecoins, specifically their flagship stablecoin UST, which is a dollar pegged, under collateralized algorithmic stable. It's worth kind of just breaking out a couple of those things, right?
Yeah.
So
under collateralized already concerns me.
So let's start with under collateralized, which means there's no quote unquote hard collateral for every dollar of UST in circulation. And so a hard collateralized protocol would be something like MakerDAO, which you might have heard of, where one DAI is collateralized by more than $1 of volatile cryptocurrency. And it's more than $1 because the underlying collateral is volatile. And so if you just had $1, well, you could quickly become under collateralized if the volatile collateral slipped. So UST was under collateralized. For a long time, it had zero quote unquote hard collateral. And so it was only collateralized by Luna. And we'll get to that dynamic in a little bit. The second word is algorithmic. So algorithmic just means smart contracts govern the pegging mechanism to make it stable. The third word is stable currency, which means that it should be low volatility, right? There are higher volatility stable currencies out there, but in general, you want it to be pegged as closely as possible to the reference currency. And in this case, the reference currency is the US dollar. And so that is what UST was purported to be. Now, the way I analogize UST, the relationship between UST, which is the dollar peg stable, and Luna, which is the governance token and security token of the network, is to use a TradFi analogy. And the traditional finance analogy I would make is something like a Visa network, which has two predominant securities. One is Visa Equity, which we're all familiar with. And Visa Equity gives you ownership in the network and gives you a claim on a share of the network revenue. That is fundamentally what equity is. And then imagine if Visa also had a Visa coin, which was essentially a coin pegged to the US dollar. And Visa's promise to you is the way that Visa coin has value is anytime you want to exchange Visa coin, we'll give you $1 worth of Visa equity.
Okay.
So if Visa stock were at $10, for instance, and I wanted to exchange one Visa coin, I would get 1/10 of a share of Visa back. So it's just like UST Luna, it's not hard collateralized. It's this kind of circular thing where the currency on the network is backed by an ownership share of the network.
Okay, I'm following you.
So that's roughly the way that it worked. So now the question is, why would anyone want to use Visa coin, or to go back to the Luna case, why would anyone want to use UST? You need it to gain wide adoption, right? The reason why people were incentivized to use UST was they paid you 20% per year through something called Anchor Protocol to hold it.
This was my first red flag.
Right.
It's quite a high interest rate.
Right. Now, Anchor Protocol launched at a time when there were yield farms, 3-figure yield farms, 100%, 200%. So 20%, it's hard to believe now that we're in kind of a bear market. Seemed like a very reasonable rate at the time.
Can we go back a step here? How can any yield farm generate 100% in returns? How are they doing this? Because again, I know little about yield farms, but the little I do know is that some of them, they work until the rug pull happens and then they collapse.
I don't think that's a horrible mental model. I would think of it like yield farms are created, high APRs are created by inflationary rewards. And inflationary rewards, again, to analogize to traditional finance, means I'm handing out equity. Now imagine if you invested in a business that said, if you do something that benefits the business, we will issue you a bunch of share-based compensation.
Okay.
We'll give you more shares in the underlying company. So if you do something that helps Visa Network, we'll just give you more Visa equity. Now, at today's dollar rate, at today's dollar valuation of Visa equity, that seems like I'm making a lot of money.
Uh-huh.
Now, is that sustainable? You have to ask yourself whether the inflation rate of the equity is sustainable.
Probably not.
So it's not clear, but we haven't seen very sustainable yield farming strategies because extremely high inflation is not sustainable.
Mm-hmm.
You can't prop up the value of the underlying and emit a large quantity of it into the circulating supply forever. It's probably not going to happen.
So when these happen and these yield farms collapse, who are the losers? Is it the bag holder? Is it a game of chicken?
Yeah, I would say it is a game of chicken, but no different from any other marketplace, right? When SaaS multiples collapsed over the last couple months and the likes of Peloton and Zoom and Snap all went down 80, 90%, who were the bag holders? The people who didn't quite realize that, multiples would contract. Now, this is maybe a slightly different case. You could say that high emissions are destined to bring prices down. I wouldn't necessarily argue against that.
I mean, I would say that the difference with something like Peloton is that it was a company that produced a product that has a revenue model that hopefully would deliver dividends at some point. And sadly, what happened is the business couldn't keep up with the growth trajectory and therefore it eventually collapsed and collapsed quickly. And they had some other, obviously, internal issues. I see the comparisons, but what I find with these kind of crypto products is then they don't tend to have an actual product itself.
So it's worth talking about the circularity in the context of Luna UST.
Yeah.
The dream with Terra Luna was the more UST is adopted, the more transactions happen on the network. And just like Visa, the more transactions happen on the network, the more the network processors, in this case, the network validators, the ones actually executing the transactions, get in terms of fees. And the more they get in terms of fees, the more fundamental value Luna should have.
Hold on. Would it be actually fair in some ways to compare this to almost the bootstrapping of Bitcoin? Because Bitcoin had an inflation rate in some ways.
Yep.
But Bitcoin has managed to sustain its price with new people adopting Bitcoin at a rate that is generally outperformed the inflation rate of Bitcoin. But Bitcoin had a decreasing inflation rate.
Yes. I think that's a very reasonable way to think about it.
Okay.
That Anchor protocol, which is essentially the high yield savings account of Luna UST, was meant to be an initial bootstrapping phase.
Yeah.
Now, it didn't, if you really think about it, last all that long, right? And so, yeah, the 20% sounds like a lot. Let's say, at the peak, I believe the circulation of UST was 15 billion. So, and something like 70%, so let's call it 10 billion was staked. And they were giving away 20% a year. So they were giving away $2 billion a year to get people to adopt this thing. Now that sounds nominally like a really high number, but Luna's market cap was something like 60 billion. And so one of the things they were doing was liquidating the Luna token to put into the Anchor Protocol reserve to pay out this high APR rate. And one mechanism we actually haven't touched on yet is the redemption between Luna and UST. Is that you can always redeem 1 UST for $1 of Luna. And that would be burning a UST and then minting $1 worth of Luna. And so the supplies of UST and Luna are inversely related. So the more UST there is, the less Luna there is. So Luna must be burned to create UST. And when UST is redeemed, it goes back into Luna. So that's the relationship between those two tokens. And the idea with Anchor Protocol was if everyone believes in Luna, then the price of Luna goes up. Then if one Luna is worth a lot, it can be burned to mint a ton of UST. It can also be sold into the open market and fill up the Anchor Protocol reserve to pay out UST holders. So there's this really great reflexive upcycle where when the number goes up, the supply of UST goes up, Luna gets sold to fill up the Anchor Protocol reserve. All the UST holders get a sustainable 20% on their income. The Luna supply goes down, which further compresses the price upward because you're burning supply. And for the same level of demand, the price of Luna should go up. So there's this really amazing reflexive upcycle that you can imagine might get you to extremely wide UST adoption. And if UST is adopted very widely and used commonly between people, right? Let's say, we went to 5 Leaves today and you got a burger and I paid for it and you Venmo'd me in UST and we were used to using UST in our day-to-day, then there's really no reason to exit, right? At some point, UST becomes as good as money to you. That was really the goal.